most wealth is lost by how people manage cash flow. All right, welcome to another episode of the Practical Wealth Show. Today's topic is cash flow control. Okay, controlling cash flow. And I was just at a conference, so shout out Currents, where that was the whole message. And it's funny, I was looking at some of my old journals, and I have been chewing over this topic for years, because I had a mentor a long time ago said a couple things. One, wealth begins in the mind, but ends up in the bank account or your wallet. And also what I find is that most wealth is lost by how people manage cash flow. On the business side, which will be a topic discussion, but on the personal side, right? And there is no structure to cash flow. So most people are caught up in transfers of their wealth to people that create the situations, control the outcomes so that they profit. So the banking system, the checking account is a spending account. So if you leave it in there, surprise, surprise, you are going to spend it. And so one of the things is that a lot of times I will show like Rich Dad, Poor Dad. And when you look at Rich Dad, Poor Dad, which is a book about accounting, right? Financial literacy is accounting. And so there's the income statement, and then there's the balance sheet, right? So the income statement, which you would call a budget, I'm going to show you, we'll get into why budgets don't work, but just here's what's coming in and here's what's going out. And, understanding that is key for financial success. And most people don't look at that. Like you really should look at you should do a personal P&L every 30 days at a minimum. If you're in business, if you don't do it weekly, you're crazy. All right. And I hate to be so harsh. I come from retail. I had to do my P&L. Here's what came in, here's what went out, here's the expenses we met. And then, I was in the bar business. So there were ratios I had to learn the hard way that, I had shrinkage. People were stealing. And if I didn't know my numbers, it didn't matter how much money we grossed, because if I was spending too much money on liquor and beer, for example, we were losing money because the money wasn't making it to the cash register. I had to go out and buy new stock for money I didn't make more money for. Okay. Today we're going to go over 4 things to track for financial confidence. And so the first one that we're going to track that you need to be aware of, because think about this. If you can't control your income statement, somebody will always control you. All right. Because you can't be free. If you don't become master of your money, you're a slave to everybody else's intentions. Ooh, is that harsh? Yes, I hope so. And so what happens is the first thing that we're going to talk about today is 3 types, right? So they're inflows. Okay. So money coming into your personal economy. Okay. And so that's your salary. That's side gigs. So maybe you have a home-based business. You're doing network marketing. You're driving for Lyft or Uber, Instacart, right? What else could you do? See, because most of y'all need to have a side gig, because I'll tell you, your number one outflow is taxes, right? So you have to create a structure that allows you to minimize current and future taxation. So you need to know what's coming in. How do you track? All right, I've got and separate. So let's say you've got a job or a couple of jobs, and your spouse has a job. Okay, what's coming into our household? That's the inflow. Do you have a side hustle? Are you making a little bit of money? We have a lot of our clients doing like what's that thing called, Hire Car or Toro, and they got side gigs. They've got real estate, a couple, 3. I've got people with 40, 50 units. So it's not their side gig, that's their gig, but they've got good jobs, and I've got people with good jobs, and I got, anywhere from 1,000 to 6,000 or so in income from their properties, right? Well, where's your money coming from, and where's it going? All right, because they commingle it, so they don't know what from what. And so so we have to sort that out. So I'm looking at, I do this every month. So I'm looking at where I got these subscriptions on the business side, all these subscriptions. I'm like, do I use this? Have I used this software? So I'm going through a personal, I guess, self audit, looking for, leaks in my bucket. Most people are leaking, um, money, and so what you want to do is you want to look at your inflows and, uh, make sure that you keep more of what you make. So a lot of times people have a side hustle, but they don't adjust their W-4, right? So you're having too much money withheld. So you get the dopamine hit of a big tax refund, but you gave up control of the money for a year that you could have been saving, that you could have been using to attack non-preferred debt. You should be saving first. And part of all your earnings yours to keep, but you haven't. So you get this lump sum, and then what do? You give it away, you spend it. And you might not have run up the credit cards in the first place if you had good cash flow control and not withheld so much of your money so that you were had a shortfall, and you had to use credit cards because you had a shortfall. So you had to use future earnings as collateral and now pay them back. Okay. And so that's the first one. So you got, if you're keeping note, what are your inflows? Okay. The second thing I would look at, and this is a biggie, what are your outflows? Okay. So an outflow is money that's leaving your personal economy. Mostly that's lifestyle, but that could be debt payments is an outflow. Their expenses, insurance. So you really have three types of outflows, right? So you have what I call fixed bills. You've got variable bills, and you got discretionary income. So fixed bills are things that are static: mortgages, car insurance, term insurance, cable bills. Those are all cell phone bills. Those are static. So you know what they're going to be. So you've got to figure out what your life costs. Okay. And entertainment, eating out, gas, those are monthly, but they're variable. So you need to get a handle on that. And see what you're doing, because if you've just got a credit card with a $3,000 limit, and you say, well, I use all this stuff, I put everything on the card to get the points. Okay, I'm fine with that, but you got to zero that card out at the end of the month. If you haven't set aside enough because you're not paying attention so that you can zero that card out at the end of the month, then what you're doing is you spending money you have not earned. Okay, and then you're paying to you interest, which is what you pay to use other people's capital. And that's a wealth transfer on your behalf. Meaning a transfer is money leaving your asset column going to somebody else's. Okay. And so how do you reduce unnecessary outflows? One, awareness is the first step. So first you need to map it and figure out what they are. And then you can look at things like, well, okay, am I getting is my first thing I would look at is, how do you increase your net income? Is my withholding too high? If you think you're saving when you're funding a 401k, but you're really investing. And if you don't have, let's say you make $6,000 a month, then my baseline, my first goal, we'll come back to this in another segment, but you want to pay yourself first, and your target would be like 18,000 for a peace of mind fund, for an emergency, and then above that it becomes an opportunity fund. But you got to look for, all right, where are things I can lower, right? So if you're doing things like paying extra on your mortgage, but you don't have an emergency fund, that's a mistake. If you don't have structure in how you're trying to pay off your credit card bills, if you're getting a big tax refund, if you're funding things, you fund put 10, 12% in your 401k, but they only match you to 4 and you don't have any monies, liquid money, then for a minute, I might lower that. That will increase more your cash flow. And then now that's more money that you can build up your savings reservoir. Okay. So those are a couple things. There's a whole bunch of stuff. Do you need every cable channel known to mankind? Right? Because really, you and your kids shouldn't be watching that much TV. You read a book on how to make more money. We don't need to have this part of the conversation, right? Just kidding. And so you want to look at your outflows. What are you eating out every week? Are you and I'm not the party pooper, so I don't really care about you not going to Starbucks, but if you can't save 15, 20%, if you can save 15, 20% or more of your income, I don't care what you do the rest of it. But if you're not, then you got to go back and are you being the most efficient that you can? Although I don't like budgeting because it's a scarcity mindset, but I think you need to understand what's going on. And I think that you've got to work on increasing your inflows. That's my answer. Okay. But you need to make sure that you don't have a leaky bucket, so to speak. All right. And then a third thing I want you to think about is, okay, you either have or you need to create free cash flow. Okay. And so free cash flow is important because the gap between your income and your spending, that free cash flow is where wealth comes from. So are you saving that to eventually invest that in one of the three asset classes, or three majors, four, but let's talk about the three, what I call the ugly cash flow triad: business, real estate, paper, and with the emphasis on buying assets to generate cash flow. Or you can fund your qualified plans to focus on and hope the market goes up. I don't know, hope is a good strategy, but you can focus on growing capital gains. Okay, but really I want my money to go to work so Kurds don't have to work, right? And so and what I would do to calculate your emergency fund, I said this, is just, it's really your peace of mind fund. So that's different for everybody. If you've got stable employment, maybe it only needs to be about 3 months. But ultimately, our goal for liquidity at Practical Wealth for people is 6 to 12 months or more. 6 to 12 months, because people get laid off. I just got off the phone with a client that was out of work for 3 or 4 months and had a real estate project going on. And it was stressful and they had to scramble to come up. Why? Because they were too illiquid. So when I work with people, they just don't put a premium on access to capital. And I think that's a mistake. And so when your free cash flow, and then part of your free cash flow, the first thing you want to do is build up your emergency opportunity fund. So 2 to 3 months, and then 6 to 12 months. Everything above 3 months is your opportunity fund, where the goal of that money is to buy or build assets that generates more cash flow, right? You're buying assets. Income follows assets, all right? And then, so once you do that, all right, now you can so you got a safety net. See, too many people build their house on what I call sand, right? And so they don't play. So it's like you're taking a cruise, let's say on a sailing ship. So back in the day, I was watching these tall ships. One time I went to go visit the Mayflower reenactment at Plymouth Rock, Massachusetts. And they were used to going back and forth. By that time, I think by the 1700s, they knew how to get from Massachusetts. But you can't just have but they provisioned, right? They knew how long it was going to take, but they prepared for rough seas. What happens if you've got bad weather, hurricanes, icebergs? Like, you got to prepare for that stuff. You can't just because it's sunny when you leave port, it's not going to be sunny all the way across the Atlantic. And see, so a lot of people build their game plan with no structure. And if everything's all right, as long as everything's all right, but I would say it's not going to be all right. And I think, because when you look at most of the problems that upper middle income America face, is a function of cash flow control. See, everything else is a symptom. All right. Oh, credit Curtis, my credit's bad. Bad credit is a symptom, okay, of what? No control of cash flow. So you're spending money you've not yet earned, and then you got behind on that. Your debt ratio is too high. Okay. Because I want to fix my credit. You don't really fix credit. You got to pay your stuff on time and keep your debt ratio intact. That's 65% of the credit of the FICO score right there. And the what's another symptom? Oh, we have a program called Debt Free for Life. But where did the debt come from? Again, it's a function of cash flow control, not paying attention. Sometimes life happens, which is you get sick, you get laid off. Again, that's a function of not having good planning and cash flow control, not having money for emergencies. And it's tough. I mean, that's why you got to go back. You always got to focus on how can I increase my inflows. I hope you see a pattern here. Inflows, outflows, free cash flow, emergency fund. So, what I want you to do and what we help people do is income management business is to help people track those 4 things. And then what do is we help people track them quarterly, because you're always calibrating, right? Things go up, fees come down. But what you'll do is if you know your numbers, it's easier to make smart decisions, right? It's easier to feel confident about your choices when you know your numbers. And so most people want to, one of the first things I do is help people get in touch with their numbers. See, if you know what's going on, you'll know what to do. See, if you don't know your numbers, or if you know your numbers, you won't get disrupted for lifestyle or rash choices. Oh, I want a car. I deserve a car. I had somebody, I went over them. We went over their numbers. It's like, okay, I hear you, but are your goal to become financially free, or you want to front? Well, I've never had a new car. But as going through her numbers, this is okay. Well, you got $6,000 a month of free cash flow. I guess you can afford what was in the payment? The payment ended up being $800, like $1,100 all in with insurance. So I was like, okay, you can do that. But here's a trade-off. You've got these 2 properties. I need you to get these properties fixed up because that will put another $5,000 a month in your pocket. And the truck, she did use it a lot for business, so she created a write-off there. You don't buy it for the write-off, but that's if you don't let the tax tail wag the dog, because tax is your number one outflow, right? So you got to learn how that works. You'll have a buffer. Here's the other thing: if you know your numbers, you'll have and you focus on having liquidity. You'll have a buffer if something goes wrong. Not to wish any bad luck when something goes wrong. Okay. You have to have a buffer. And then what happens is if you are planning ahead, if you're reviewing your stuff quarterly, then what can you do? You can make proactive decisions on your free cash flow. Okay. I've got my baseline I want to have is 15,000. We've restructured your savings, so now you got 25,000. So you're 10,000 over and above your free cash flow, and you're adding new money to your what we call your reservoir every month. Well, what could you do with that? If you don't have anything imminent, then what you should do, you should save it, and then you should be looking for assets to buy to grow your income flow or your inflows, right? From other engines outside of earned income. And so, you kind of need to work with a team that has a philosophy to look at this every quarter. And what it'll do, it'll help you hit your goals faster, let's say. All right. And so, just to recap. So what I want you to check is your inflows, your outflows, your free cash flow. Do you have any? See, if you don't have any, why is that? What if you could work with somebody that will help you improve your net pay? That is our income management. That is our cash flow mapping process. So in the show notes today, I'm going to put a link to an article that we wrote on this and a link to I have a free report called Budgeting Stinks. And also, you can get in a conversation with me or my team, and we can do a cash flow review, a cash recovery audit, if you will, to see if we can help you improve your net cash flow. So what we'll do is we'll walk you through what we call a cash flow exercise that I think will be very important to your life changing to your finances if you can get control of your cash flow. Because if you can get control of your cash flow, everything else works better. Okay, because if your cash is up, your anxiety is down. Okay, if your knowledge is up, and you look at your numbers and you open your statements and you look at your 401k, like you need to look at your picture, your overall picture. It's the saying that which gets measured gets done. Okay, so you have to measure, you have to track. You got to track your inflows, what's coming in, what's going out, how much did I save from my savings, what assets did I buy so I can increase my inflow. So there's a pattern to this stuff. And so it starts with right out of The Richest Man in Babylon. So here's a book I'll link to this that you should get, Richest Man in Babylon. Part of all you earn is yours to keep, and you have to spend your inflows need to be greater than your outflows, or as Myron Golden would say, if not, your upkeep becomes your downfall. All right. So listen, I hope this lesson helps somebody out there, and go out there and make a great day.